more from from the government, or rather should I say the RBI actually. On Friday, we did have the Reserve Bank of India's Monetary Policy Committee meeting. The outcome of it was announced, and yes, they may have held the repo rate or the interest rates, but there were a whole host of other measures announced in the policy, including, and bear with me, these are some terminologies that are associated with macroeconomics, but I'm going to very soon be joined by a guest who will break it down and simplify it for all our viewers. There were OMO operations, LTRO operations, increase in OMO operations as well, SDL OMOs, and yes, I know I've been throwing a lot of jargons, a lot of acronyms as well at you, but all of this essentially would affect your debt mutual funds. Remember that RBI policy announcements should be read in mind, especially if you are a retail investor, you largely investing in debt mutual funds or in mutual funds. You should sort of listen to the RBI announcement on ET now and keep your debt mutual funds in mind. In fact, to help you sort of understand all of that, we have with us Devang Shah. He's the Deputy Head of Fixed Income with Axis Mutual Fund. Devang, thank you so much for joining us today on the Money Show. So, like I mentioned, interest rates have stayed put, but there have been lots of other announcements from the RBI. So for the sake of our viewers who are largely debt mutual funds, if you could just summarize all of them for us.
Sure. So to start with, I think RBI monetary policy was very dovish. Though there was no direct rate cuts, but actually the impact of that was much more higher than a rate cut. We have actually seen yields across the curve around 15 to 20 basis lower in the last two trading sessions. I think the most important aspect of the RBI monetary policy was that they have given an accommodative stance till March 21 and even beyond that. So it is actually that, as you rightly said, RBI is ready to overlook at the tentative increase in inflation, which is temporary, and they are actually looking at more impetus to the growth cycle. So the entire focus has been on the growth cycle. So net, if I summarize, I think a very, very dovish policy. The tools which RBI used are actually to improve, one, the liquidity into the banking system. So LTRO is nothing but providing a banking system with a lot of the on-tap LTRO is 1 trillion, INR 1 trillion. So it is providing banking system with that kind of liquidity to start with onshore lending. So somewhere down the line, the entire thought process is to pump prime the economy with the uptick in the credit cycle, push credit into the system as much as possible by keeping the banking liquidity very, very positive. The second tools the other tools which RBI used was to increase the limit and size of OMOs, open market operations, from 10,000 odd crores to 20,000 odd crores. And secondly, they have introduced a new tool of doing open market operations even in state development loans. The why this tool have been utilized and used by RBI, the reasons have been that we have actually heard a lot of noise on account of this borrowing program this year because of lack of tax revenue. Somewhere down the line, government wants to spend more to ensure that the economy comes back on track. And this expansion in fiscal led to a lot of additional borrowing in government bonds and state development loans, which was creating some kind of volatility in the bond markets. And hence RBI, to soothen up the entire capital market as well as ensure that the borrowing programs goes through smoothly, did increase in the size of OMOs for government bonds and also introduce this OMOs for SDLs, which is state development loans. Secondly, they have also provided an increase in HTM limit, which in simpler terms means that banks can add government bonds and use them for their HTM limit. That extension has been given from March 21 to March 22. So all the steps which RBI has taken is, one, to ensure that the credit flow continues to the economy, and which is done by on-tap LTRO. And secondly, steps like increasing OMOs and HTM hike are to ensure that the government borrowing program doesn't see any kind of volatility in yields, and it sails through quite smoothly. So that's the thought process of the regulator.
Right. Understood. Devang, if the intent behind all of these measures announced by the RBI is to flatten the yield curve, as we call it, in simple words, how would I, as a debt fund investor, be impacted?
That's a great point which you have raised actually. So what we believe so is that today, if you look at the curve is very, very steep. If you look at the 1 year segment, the 1 year segment is at 4%. The 10-year corporate bonds or GSEC is at 6 and 6.5. If you look across at the spreads, they're at 200 to 50 basis, one over the 10 years. So 1 cross 10 is at 200 to 50 basis, which generally in Indian markets we have seen around 150 odd basis. So there's a 100 basis steepness which is on account of this positive liquidity to the system. Secondly, if you look at the spreads of 3 cross 10 also, the 3-year GSEC corporate bond versus 10-year corporate bonds in GSEC, there's an 150 odd basis of spread. These are all-time high spreads, nearly a decade high spreads. So we believe that somewhere down the line, in the next 12 to 18 months, due to all the steps which RBI is taking, RBI is trying to protect the yield curve by doing a lot of open market operations and significantly improving the banking liquidity. In the next 12 to 18 months, we believe that the curve will start getting flattened, and how the investors should get benefited out of it is by investing in barbell strategies. What do we mean by barbell strategies? In simpler terms, invest in extreme short bonds and long bonds. The long bonds offer a higher carry because of the steepness being built into the curve, and the short bonds will start maturing themselves before this entire rate hike starts coming into the system. So we believe that we are nearing the end of the rate cut cycle, and in the next 12 to 18 months we will start seeing the rate hike cycle. Before that, a lot of your mature portfolio will get matured, and which will be good for reinvestments. So short to medium term strategies which are investing in this barbell strategy, which is investing in short bonds and long bonds, are the much I would say advised product for investors at this point of time.
Okay, all right. Short term and long term. That's called a barbell strategy. Extreme short term and extreme long term, rather. But what would you advise those people who then have long duration funds? Because many a times, investors invest in long duration funds, especially when they have a more longer term goal, say 5 years or something down the line. So they invest in long duration funds. Should they not be too worried about the RBI's intent to flatten yield curves?
So I would say at this point of time, it is okay to stay put, because we believe that the steps which RBI has taken in the near term would lead to a rally in the long bonds also by another 15 to 25 basis. But on a medium term, for a 3-year investor from here on, we believe that short to medium term funds with a barbell strategy and all the thrust which regulator and government is putting on the growth cycle also gives a lot of, I would say, benefits for investors to start looking at strategies with AA corporates, because AA corporates are offering significant higher yields, and the spreads over AAA are also very, very attractive. So for a medium term investors, I would say short to medium term barbell strategies and portfolios which has AA allocations makes lot of sense at this current environment.
All right. Devang, just wanted to get in your view on gilt funds, because as a category, this has been doing very well amongst all the debt funds, and fixed income funds. The last 1-2 years, double-digit returns coming in. Do you think that this will continue doing well, or is it just because people are so scared of investing in, subpar credit quality schemes that they have been going to, gilt funds, which relatively have almost zero credit risk?
So our thoughts are that we are nearing the end of the rate cut cycle. If you look at the various macro analysis and you look at the growth environment as well as the inflation prints, I think somewhere down the line the room for rate cut for RBI looks very, very limited. We have already had more than, I would say, 200 basis of rally in the last 18 months, and it has been one of the longest rallies in fixed income markets. So yes, in the near term, we can see gilt funds continue to do well and give some better returns. But for a medium term investors from here on, our advice is that short to medium term funds with AA allocations makes and Barbell strategy makes the most sense. With limited rate cuts from year on, I think capital gains incrementally in gilt funds look limited.
Right. Just also wanted to get in your opinion on deposit rates, because, and the reason why I'm asking you this is because usually when investors look at investing their money, the first port of call is usually fixed deposits. But now with what RBI has said, it doesn't look like deposit rates are going to go high anytime.
So see, we would not want to comment on the deposit rates, but if you ask me generally, what we believe so is that rate, because RBI is going to continue on an accommodative stance for long. Secondly, liquidity in the banking system is hugely positive. Credit offtake is there, but I think it is still slow. So all this augurs for actually rates to go down. So across the curve, I would say for fixed income markets, lending rates, deposit rates, rates will come down. Do we see rates going down by 75, 100 basis from the current levels? I think no. Probably, I would say 25 to 40 basis from current level for the entire curve is what we believe rates will go down.
All right. Well, Devang, many thanks for joining us today on ET Now Then, and just very easily breaking down all of these concepts for our viewers as well. And I hope that in the next bi-monthly monetary policy meeting, when you're listening to the RBI governor on ET Now, you are also able to sort of decode what the RBI governor is saying, what it means for the debt fund part of your portfolio as well. Okay, we'll take a very short break right here on the show. When we return, we'll be joined by Mrin Agarwal to talk about the newest tranche of the sovereign gold bond scheme. Don't go anywhere.